For the past few years, there has been a campaign to push for more growth and equity in Massachusetts by raising taxes on the wealthy. Supporters say the new revenue could fund critical improvements in education and public transportation. But opponents warn that revenue gains could be eroded by tax avoidance and migration of businesses, not to mention wealthy executives. That's part of the lesson drawn by the Pioneer Institute in its look at the results of higher taxes in California, ushered in by Proposition 30. To tell us about the report is Pioneer's economic research analyst, Andrew Mikula. Thank you very much for being with us, Andrew.
Thanks so much for having me, Chris.
Andrew, for people who don't follow California that closely, people like me, I guess, what exactly is Proposition 30?
Right. So I guess for the background, we really have to go back to the Great Recession of 2008, 2009. California, like a lot of states, was struggling to balance their budget because of a sudden dearth of tax revenue. And they ended up cutting some $56 billion in services over the course of 4 years to try to deal with these budget gaps. So in 2012, they decided to prevent even more service cuts the following year by raising their income tax rate by up to 3 percentage points, depending on the bracket. And the revenue from this tax hike was enough to close California's budget deficit in the short term, but more insidiously, it corresponded with a staggering amount of disinvestment in the state's economy from businesses and individuals, which at an extreme means people leave the state. But Pioneer's recent research on this draws heavily from a 2019 study that shows a huge spike in outmigration, particularly among wealthy people from California after this 2012 tax hike. And it also shows that by the tax hike's second year in effect, over 60% of the potential revenue gains that California would have obtained from it were lost to these behavioral responses.
Now, Chris, I look at growth figures from California up through about maybe to 2018. It didn't look that bad. Things slowed down in 2019. And now we're having all these headlines about people bailing out of California. Why is it getting, at least, why does it seem to be getting so much worse so recently?
Yeah, so I think the effects of these tax hikes have been cumulative. It's worth pointing out that um, revenues have actually exceeded expectations from projections from Proposition 30. But that doesn't negate the fact that revenues would have been a lot higher without the behavioral responses of the wealthy. I think you factor in, a better than expected stock market performance, and it's also possible that the initial revenue projections were simply, poorly done. But in many ways, like I said, the effects of the behavioral responses are cumulative, and California is leaving itself vulnerable to revenue volatility and tax avoidance, and more broadly, the whims of a small group of very, very wealthy people by taxing more citizens at the top instead of pursuing, base broadening and similar effects. And I think it's one thing when, you have a recession like we do now, where the stock market defies the rest of the economy. And, so it might not be a huge issue raising revenue relative to, say, a Great Recession that started in the mortgage market. And, when those tax revenues from the wealthy start to go down a lot, it's eventually the low income people that suffer the most because you're forced to cut services to balance your budget. And that's exactly what happened in California between 2009 and when they passed this tax hike, Proposition 30.
I'm assuming there's little sympathy out there for rich individuals who
Of
whine and
course.
they move to another state. But one thing that should be more concerning, I guess, is what happens with these individuals on paper who are really small businesses and their opportunities for growth. How would that be affected?
That's right. So a lot of small businesses actually pay taxes through the personal income tax returns of their owners. And in most states, including California, these pass-through entities actually employ the majority of the state's workers. So this sort of tax policy that targets income tax rates at the very top will actually have a direct adverse effect on a lot of small businesses. Um, Now, I'd also say that California is known for having a unique startup culture that allows the small businesses access to a lot of venture capital and cross-pollination with innovative firms. And that's not necessarily going away when you raise taxes. But I think it's certainly a uniquely vulnerable time for these kind of uh, innovation economies when so much of their talent and their businesses are moving online. Facebook, for example, is one of the first firms to say, oh, all of our employees are going to be remote through um, next June or whatever it was. So what does that do to the kind of location advantage of being in California that the state has accrued over the last several decades?
Yeah, what about that? Because before the pandemic, we heard about certain cities, including Boston, that were great magnets for recruiting high-end talent because all these people want to be in the same location. But where it's so much easier to disengage a footprint now, what does that mean?
Absolutely. I think, well, it's a little too early to have all the IRS taxpayer migration data from during the pandemic. But I think the rise of remote work during COVID has absolutely exposed a vulnerability in Massachusetts to a future that potentially places less of a premium on working in a big, expensive urban area like Greater Boston. And so during the pandemic, at least temporarily, employees get to see the benefits of skipping the commute for most or even all work days. And employers get to think, hey, maybe I don't need all that downtown office space that costs a fortune. People place a huge premium on having proximity to jobs when they make location decisions. It's a major reason why people move to Massachusetts and stay here. So when you're in an environment that's eroding that advantage, the Zoom economy, remote work, it makes it even easier for people to leave. It lowers the barrier to exit, if you will. Excuse me,
Yeah.
Pioneer is concerned that post-pandemic, the behavioral response we would have seen from a tax hike or similar policy change will be even larger. So that's why we're pointing out that the baseline for this sort of scenario is what happened in California in 2012, which is already pretty devastating.
As you point out in the report, the places where these people leaving California are going to, like Texas and Florida, they are much more business friendly as far as taxes or personal income taxes. But on the other hand, is that the only reason you think?
Well, I don't think so. I think the cost of living is absolutely a factor. I think uh, I think that the tax burden is a part of that cost of living. But when you're a company that can whose workers can work remotely, that also is going to allow you to essentially reduce wages because you don't have to essentially compensate for the fact that your workers need to pay California's housing prices. So there are certainly other things besides the tax and regulatory climate that are affecting these changes. Yes, it's a more nuanced issue. But I think when you look at Massachusetts, one thing that people often focus on is the weather. Places where people are moving when they move out of Massachusetts, like Florida, that's somewhere you can play golf year round, right? Go to the beach year round. Um, but I think the issue with that is, um, state policymakers don't control the weather. We do control or have some control over the tax and regulatory and business climate.
Well, you would think that whether it's Proposition 30 or some of the ideas being proposed in Massachusetts, that a lot of the wealthy tax increase would be on a relatively small group of people. But what would you say, from looking at California, about how much influence a relatively small group of people can have on a whole state's economy?
Yeah, I think one of the best examples of this is actually not in California, but in New Jersey. I think it was in 2016. They lost one of their wealthiest residents to Florida, and the impact on state coffers was calculated to be something on the order of $150 million, which is certainly not just a drop in the bucket. It's the danger of relying on, a very small group of people to fund core programs at the state level. Um, so I think the overall share of wealthier people moving between states in a given year tends to be lower than the share for lower income people. But on the flip side, you have to look at the impact they're having on state revenues and the economy as a whole uh, when you try to extract more value from them.
Right, right. Well, thank you very much for sharing that wisdom about California and giving us some pause for considerations here in Massachusetts.
Thank you so much for having me, Chris.
That was Andrew Mikula from the Pioneer Institute. We'll have more news in just a moment.